Hi, Larry Berman here, and here's what's on my radar this week. When we go to technical analysis school and we do our chartered market technicians accreditation, you learn the very basics of market structure and market breadth is an important concept. So is relative performance. So this week I wanted to look at some key elements of market breadth and some key elements of relative performance. Because when you look under the hood like this, sometimes and more often than not, you actually get to learn quite a bit. So let's have a look and let's take a deep dive on the terminal and see what we come up with. So what we're looking at here is a bunch of indexes that represent North American markets and various different breadth indicators. Percentage of stocks making one month lows, percentage of stocks making 1 year lows and highs. You can see that the highs are few and far between these days, as you would think. Percentage of stocks above their moving averages. I want to feature this one. Percentage of stocks with overbought and oversold readings on RSI. There's one stock in the entire NASDAQ index that's overbought at the moment. And then the percentage of stocks that have a MACD momentum-based buy or sell signal. You can see whether we're looking at the Dow, the NASDAQ, the Russell, the S&P 500 indexes, or the TSX, that breadth readings overall are pretty low. Focusing in on the percentage of stocks making monthly lows and annual lows, you can see that these numbers are actually, well, maybe you can't see from this lens, but with history in mind, these numbers are actually getting pretty big. When we look at the market breadth and the percentage of stocks above trend, for the S&P 500, the percentage of stocks above the 200-day is now 11%. That number historically lines up very well with a market bottom. 2% of stocks are above the 50-day average, 1% of stocks above the 10-day average. So we have very extreme market breadth readings on the sell side. Whether you look at the S&P 500, 600, mid cap, large cap, you name it, very, very deep oversold region levels. When we look at the individual sectors, one thing that's pretty interesting here, of course, this is the S&P 500E. It's cut off a little bit there, but that's the energy sector, as you can see in the label I've highlighted. 86% of the stocks in that sector are still well above the average. And this is where the hate mail is going to start to come in a little bit for me here. But when we look at this index and we look at relative strength, the candlestick chart is the S&P 500. Year to date, you can see lower lows and lower highs. And for the most part, that trend is still intact. When we look at the axis here, that's the price level of the S&P 500 SPDR ETF. We'll know technically, and we commented a few weeks ago that this low in May we thought would hold, that hasn't. But we thought that was going to be a good low. That hit the 38.2% retracement right on the needle. And the next level of support is just above 3,500 on the S&P. We haven't tested that yet. We very well could in span of the next couple weeks. I do expect, given the nature of the oversold rally and the fact that it was really triggered by the CPI report and the surprise there. Listen, folks, that surprise was a rounding error. And so since that has hit and people are more worried about recession, when you look at the group relative performance, what you see here in the call we made a few weeks ago was be very, very nervous about the overbought energy sector. And the worst performing sector relative to the S&P since this high inflation. Again, it's not an inflation hedge. If we're going into a recession, it's actually something you don't want in your portfolio. So again, I know I'm going to get a lot of hate mail on this, but that's the way it's playing out. So I talked about me owning a ratio put spread. I was long a put to make money on the downside, and I was short two puts to actually buy the dip. Today, I covered the long end of that put, and I exposed my naked puts for October at an average price of around $61 on XLE. So really happy owning it on a pullback. I do like this sector, but I didn't like it at 90. There is a difference, folks, between a good stock and a good sector and a good time to buy and not a good time to buy. And it just wasn't. The probability, because it was so overbought, that it was going to have an at-risk pullback. What sectors have outperformed? Well, consumer staples. We added to consumer staples in the last week. When we look at what else is outperforming, XLV, healthcare is outperforming. Financials have started to outperform. The traditional defensive sectors have started to outperform a little bit as money's coming out of the more overbought sector. So let's have a look at crude oil very quickly here. And again, that chart doesn't look bearish, does it? It looks like we're still in a well-defined uptrend. In fact, a test of the rising 200-day average in and around the 90 area is not out of scope of the market we're in now. And so there could be a little bit more on the downside here. But as I said, I covered my long put position. I took a nice profit on it. I exposed my puts so that I'm going to earn the premium over the next few months, 1% a month on that trade. If not, my average cost on XLE is going to be around $61. Nice trade. Let's have a quick look in terms of the bull and bear picks of the week. So what don't we like? Well, you've known for a long, long time, I'm not a fan of Bitcoin. What I see here in the chart is a massive top and reminds me why I don't like it. This is a speculative asset that can be traded. It can be traded both long and short. And this is something that I'm never going to recommend it in my portfolio. But when I look at the charts here and where support might be, there's clearly some support around this 20,000 level from the high back in 2018. The next range of support is somewhere between 10,000 and 13,000. We'll see how it goes, but I suspect before the dust settles in the coming months that you'll see Bitcoin in that area. So for those of you who like Bitcoin and are bullish on it, I'd be a little more patient here. Not time to buy yet. As for the markets overall, I think we're set up really good for a face-ripping counter trend rally. I'm not bullish. This is a counter trend rally. We could get up to 4,000, 4,200 range. I was thinking prior to the CPI print that we would, see a better rally than that. But we need to get higher than that today. And now we need inflation really to start moderating. And as the Fed said this week, we're not going to know for a number of months, and they really have no control over it. So it's going to take time. But I think as inflation does moderate, stocks can stabilize here and have a good counter trend rally. By no means is the bear market over at this point. Inflation would have to fall rapidly, way more than the Fed thinks, or anybody for that matter at this point, and I just don't see that in the cards. I do see inflation being stickier, and I think that ultimately, folks, is part of the challenge. So, I hope everyone has a good week. Still, you want to be pretty defensive in your portfolio here. Have a great one, everyone.